Hi, this is Ray Mulaney with Exceptional Investing. We provide institutions, financial advisors, with risk research about the stocks that they may or may not be buying. It'll help you in a couple of ways, primarily because it'll help you avoid losses if you avoid risk. And number two, maybe more important to you, or certainly very important to you, when you're competing for business, your prospective client's going to be asking, how safe is this investment? With our tools, you can answer them honestly, objectively, and fully. Number two, they'll be asking, what happens during a crash? You know, the stocks you pick may be good, but what happens during a crash? We have qualitative and quantitative research to show you what happens during a crash. And lastly, they might ask, if they're really smart, have you back-tested your approach to investing to see how it would work over the long term? And you might not be able to say you did it, but you certainly are welcome to say, if you're working with us, you work with a research firm that does have back-tested results. And that's probably where I should start. I've been in the investment business truly for 40 years. And I've been registered, or was registered, from 1980 or 79 through 2 years ago. For the past 4 years, I've been working on developing on my ideas and building a computer system to sort and filter and identify financial risk. Not all the risk a company has, but significant financial risk which are objective. So we looked for companies with our tools to find the safest companies. And I'm going to show you the results of backtesting a model that we developed to find safe stocks. I think you'll find it surprising, and hopefully you'll find it very encouraging. This model shows that you can't see how safe the stocks were, but we're ready to show them to you. It shows you horizontal lines. The S&P 500 gained over the past 15 years roughly $237,000 from a $100,000 investment. I shouldn't say gained, grew to $237,000 from $100,000, where our selection process gained approximately $1 million. So beating the S&P fourfold. And if you look more carefully at the vertical lines, you can see there are times when we simply couldn't find stocks. I'd be glad to share with you the model, the selections, and share with you some of the metrics we used to select those stocks and why we were out of the market so much of the time. That's all quantitative. I have something else to share with you. I'd like it to be my calling card, but it's a little long. This letter I sent to the Securities Exchange Commission in the year 2000. In the summer and fall of 2000, I wrote reports to the SEC explaining, showing them why I thought the two largest cap market companies in the history of the United States, Cisco and GE at the time, were providing misleading earnings reports and creating misleading earnings reports quite intentionally, and producing reports just generally which would imply that the companies the value was rational. You can read that letter. I'm probably most proud of that, other than this computer system we built in the past 4 years, because 17 years ago, I identified Cisco and GE as being the biggest, most overpriced companies in American history. I put it in writing to the SEC. Now I'm going to show you the charts of their performance. When I was writing about Cisco, it had a market cap of over $500 billion. It fell by nearly 90%. When I was writing about General Electric, it had a market cap of nearly $600 billion. It fell by more than 90%. I'd like to think that all I did was rational analysis of the difference between the company's price and its net present value. I'd like to establish some basics in how I work. I look at a company. Our system evaluates their financials There's a lot of metrics, a lot of algorithms put together with math. We've had over a dozen computer guys and MBAs and accountants and mathematicians, statisticians working on it. But basically, all we're trying to do is create a model for the safety of the company, ignoring price changes in the stock that are technical, like momentum and relative strength. We don't do any technical analysis, and we don't do any earnings analysis. So you might be thinking, well, how could you evaluate the safety of a stock without considering its earnings? We do it, and it works. Cisco and GE fell because their net present value was profoundly lower than their price. Balance sheets matter. Debt matters. Now I'm going to change the topic a little bit, but I haven't found a great way to introduce this topic, so I'll start with what I'd be talking to you about if I met you at a cafe. How big are the mistakes you make? How big are they? If you were buying a late model car or a Ford or GM product, you might spend $25,000 to $50,000 on average. But you'd never spend $200,000 on a Ford or a Chevy. You'd say, well, it's a Chevy, it's a Ford. It's not a Rolls Royce, it's not a Mercedes Benz. See, you probably couldn't get clipped too badly when you're buying a car. If you bought a house, if you bought it in 07, you might have spent $700,000 and found it worth $400,000 3 years later. You got clipped pretty bad. But when you invest in a company, and the market value of the company, or I should say the market price, as is the case with GE, it was nearly $600 billion. Wouldn't it make sense to ask, well, if you bought the whole thing for $600 billion, wouldn't you at least expect a 10% rate of return, knowing the future's uncertain? What's your goal when investing in a company? When a company says they're worth, because the market cap is $600 billion, and you buy shares in it, are you thinking, well, this company, the net present value of its future stream of income is worth 600? What kind of calculations do you do to figure out the NPV of a company? You certainly would do that with a piece of real estate. You wouldn't buy a property for $6 million that I hope you wouldn't, that wouldn't generate a 8 or 10% positive cash flow net. You wouldn't do it when you buy a stock. Getting back to the question, how big a mistake do you make? If a market cap is $600 billion and it could generate to the owners $12 billion, what's that rate of return? I'm not thinking about dividends. I'm thinking about if you bought the whole company. And that's really the way we look at it. We say, what's the company? We try and establish what a reliable minimum, not its value. That's a very different number. I don't know what companies are worth, but I think we're very good at estimating reliable numbers for a company's minimum value. And think about it. If you bought companies, for less than their minimum value, you'd make money most of the time. And the risk is always in a business decision, the difference between what you pay and the value, the minimum value of that company, whether it's real estate or a stock. Minimum values are a very important thing to achieve, to ascertain when you're buying an asset. If you estimated my height, if you met me and I'm in fact 5'10", if you looked at me and said, well, you're around 6 feet, you wouldn't be far off. So if you heard someone else say, I estimate Ray's height to be 11 feet, you'd know right away that person was very, very poor at estimating height. How good are your estimates of value? How good are, not you, I don't mean to challenge you, I'm trying to help. I really am. When Wall Street creates a report for Apple and says it's worth $1.1 trillion, is it possible it could be only worth $100 billion? Is it possible it could only be worth $200, $300 billion? How big what's the magnitude of the error that they could be making? What's Apple's minimum value? Certainly it's more than cash. I mean, anyone can look at the cash per share net of debt and say, well, its minimum value is $25 a share. There's got to be something a little bit better than that. But certainly a company's minimum value does not assume its growth in earnings will last forever and grow forever. That's silly. A recent article came out in the past week that said Jeffrey Immelt has been an unmitigated disaster for GE shareholders. Suppose the new chairman of Apple becomes an unmitigated disaster. How much risk does the company have versus its upside? If it fell to a reliable estimate of its minimum value, what would that be? And if all things go well, how much can it rise? We know that the guys on Wall Street, they don't do a very good job. Doctors do good jobs, engineers, very few bridges fall down. Your computer works most of the time. Your car certainly works most of the time. Think about how many miles we've logged on 747, 737. That's reliability. Reliability. Defining reliability is quite the challenge for us in the investment industry. I'm going to show you a list of blue chips to help you appreciate just how unreliable the term blue chip is. The number of companies that have disappointed investors far outweighs the number of companies that have provided investors with tremendous returns. An article in the Wall Street Journal in the past 10 days by Jason Zweig indicated that actually very few companies, out of the 26,000 companies that have traded, a very small percentage of them account for all the wealth. With all the academic studies in, it appears that about 4% of the companies that trade, out of the 26,000 companies traded in the past 90 years, 4% account for 100% of the market appreciation in the past 90 years. The other 96%, well, that didn't work out so well. I'm not in the business of finding the next 4%. I'm in the business, we're in the business of identifying risk for you so that you can avoid it, you can calculate it reasonably, reliably, imperfectly to be sure, but reasonably, so that when you're making an investment, you can have a better sense of what you can lose versus your own opinion of what you can win. We're not in the business of telling you how much it could go up. One of the key things that matters most in any investment is how much you can lose. And since we know that if a company's debt grows much faster than its equity, eventually there's going to be a problem unless that trend reverses. I want to show you a 34-year trend of 25 blue chip stocks that are still around. How does that trend look? A trend which shows debt growing over the past 34 years of 1,400%, while equity contracted nearly 50% and sales grew a very modest 359%. So these 25 companies that most people would think of as blue chips have seen virtually no growth in the past decade. They've had tremendous leveraging of their balance sheet, destruction of equity. So I think you need to know about these companies. I think you can benefit by knowing and evaluating for yourself what they mean. We can help you evaluate. We can help present the information so you can do a better job of evaluating. Debt grows a lot, matters a lot, the rate of debt. Another factor is the price to sales ratio. Now that's always been a big factor to me. I've been doing this, as I said, for nearly 40 years. I've very, very rarely seen a company that was very high market cap, and there's a difference in how stocks perform relative to their market cap. Let's get right into that right now. This chart's pretty compelling. It does not say that all mega caps are going to fall. It doesn't. I don't know which ones are going to rise and fall. But it's a review of all the companies, heck, over 15 years, that you could have bought 15 years ago with a market cap over $100 billion, and you see their performance is pathetic. The S&P in the past 15 years has only doubled. How exciting is that? Versus the performance of companies, look at the market caps of these companies that rose a lot. And another thing to look at is the ratio of gains to wins. You had not meaningfully better chance of making money investing in 10 to $100 billion companies than $1 billion to $10 billion companies. And of course, you're going to experience a higher loss rate in the microcap and the very small companies, but the rate of gain on them is extraordinary. I think more than anything, it suggests be cautious when buying a big cap stock. I have some more information on that for you. These numbers are pretty compelling. When you buy a stock, a big stock, $50 billion market cap or more, and you're paying 7 times what the price is 7 times its sales. In the past 5 years, you would have lost 83%. Whereas if you chose to invest in the same size companies, but the difference was you're buying them at a multiple of sales much more modest and realistic, and you would have only lost 14%. I'm not suggesting that losing 14% is acceptable, but it's a heck of a lot better than losing 83%. Now, I want to show you the performance of picking stocks instead of these mega cap stocks with the same not so good price to sales ratio of 7, but instead of buying companies with a market cap of 50 billion or more, we chose companies with 25 billion in market cap. And the very fact that they had a lower market cap gave them more room to expand. It's a question of market penetration and a question of market saturation. The larger a company grows, the less it has chances of growing further because of the simple market penetration and market saturation equation. In buying companies with a market cap of 25 billion or more, we see their price to sales ratio of 2 or lower. Those stocks advanced 41% versus 4% for those companies that in the same market cap category but with a higher price to sales ratio. There'll be some winners and losers, but the odds are you're not going to do well buying these mega cap. I feel the data suggests that's pretty clear. The magnitude of the mistakes that can be made are they're gigantic. GE and Cisco, those two companies, fell by $1 trillion. $1 trillion was lost on GE and Cisco, which were once hyped by the Wall Street guys as being the best and strongest companies in history. That didn't last that very long. I wrote about the decline before it happened. I've written extensively about companies that have fallen. They have an excellent record to show you, quantifiable, the date. We can show you and demonstrate the veracity and the efficacy of our system of identifying risk and of investing in companies with low risk or at least lower risk. And we can identify the system we use to measure companies' risk objectively. It's not all the risk, but their objective analysis of the risk that we can quantify. I appreciate very much your patience, and hopefully we can serve you. Again, I think the primary use of our services is to reduce and limit losses on your clients' portfolios, and win new business by showing people that A, you have a systematic way to avoid high-risk stocks, B, you are in fact using that system to identify only safe stocks to buy, or safer, and C, you're using a company that has back-tested the system, you understand it, no back-testing is perfect, it is in fact flawed. It's impossible to make a perfect system, but I think you'll see it's very reliable. Thank you. I look forward to hearing from you. ExceptionalInvesting.com. Ray Mullaney, 401-450-4040. Give me a call. Thanks for your time. Bye-bye.